Hey guys, what's going on? Welcome back to my YouTube channel. If this is your first time visiting my channel, my name is Luke and I talk about all things business, property, investing and renovations, all that fun stuff. Today I wanted to talk to you about the ideal loan structure for your first investment property. I'm going to break down some general terms between principal and interest only, why I think the structure I've come up with and have learnt from other people online and through my own research is the best for a first-time investment property. To kick off, there's two types of loans you can get when you go to a bank. This is simply, so there's principal and interest, where your repayment includes the interest component plus a principal component, and you pay that into the loan over time. So the loan balance might start at, say, $250,000 and it will decrease over time as you pay the loan down. Now an interest-only loan is a bit different. So you essentially agree with the bank that you're going to pay only the interest component for a certain period of time, and that is typically up to 5 years. Now there are some misconceptions that you can't get interest-only loans on owner-occupier properties, but that's just not the case. You can actually agree and negotiate with the banks and financial institutions to have an interest-only loan on all of your loans, whether it is a owner-occupied property or an investment loan. So you can basically take up a principal and interest or an interest-only on any loan that you're going for a residential property. Now we've got those definitions out of the way. The next step is to look at what you're doing with your investment property and come up with a strategy of what's probably the best scenario for you at your first property and at this point in time. So my strategy, and the strategy I recommend to people, is to actually go for an interest-only loan on their investment properties and to avoid the principal and interest component. The reason being is the interest-only improves your cash flow, as you're not actually paying down the debt, you're only paying the interest on your loan, which means that you have more money coming in each month between the rent that you receive for the property and the repayments that you're required to make. Whereas a principal and interest loan would force you to pay down the debt in that first 5-year period and for the subsequent 25 years. And that would actually impact your cash flow, meaning that you had to pay more money to the bank, and you were forced to do that each week or each fortnight or each month, depending on what cycle you choose to pay. Now, instead of frivolously spending your money and going out and buying extra toys or Lamborghinis in your spare time, I suggest that you take the money that you would have put in a principal and interest repayment and actually leave that in an offset. Now, I've talked about the principal and interest-only loans. Now, the next thing to talk about is whether you look at fixed rates or variable rates. The banks are currently offering, at this time in March 2021, great fixed rates, and they're currently below the variable rates. But what happens when you fix in is it doesn't allow you to refinance loans quickly and pull out equity, and it locks you into the bank at that rate for whatever term you agree. So Emily and I, for example, just recently fixed with our bank for a 1-year period at 2.19% for some of our loans. That's a fantastic rate that we're getting, and it worked for us at this point in time, but it's not what I would suggest in the ideal loan structure for your first investment property. I would instead suggest that you go for a variable rate, and the reason being is that you can get a 100% offset account with your variable rate. Some banks do 100% offset accounts with fixed rate loans, but the reason I suggest the variable is that there's no breakage costs if you want to refinance and pull out equity compared to the fixed rate. If you're in the middle of your fixed rate term, there are clauses in your contract that will make you pay a lot of money, depending on the bank, to actually break that. It could be thousands of dollars to break the fixed rate contract. Whereas compared to the variable rate contract that you have with the bank, you're much more flexible in being able to switch banks or move your loans or go back to the bank and ask for a valuation to potentially pull out equity. So, we've talked about principal and interest versus interest only. We've talked about fixed rates versus variable rates. Now let me break down for you, hopefully in a simple example, what I would do for the ideal setup for your very first investment property and how I would structure it in terms of setting up the loans. So let's just say you bought a house for $300,000 and that was a few years ago. And now the house is worth $400,000, and it's been 5 years since you purchased the house, and you don't have any other investment properties. Now, that means that the house has had $100,000 of capital growth, and you're looking to set up the ideal loan for this scenario. So what I would do would be to go back to a bank, or find a bank, or use a mortgage broker, depending on what you prefer. And I will go for a interest only and a variable rate loan with a 100% offset account. So there's three components to that. So the interest only improves your cash flow, and the bank will be likely to happy to give you a 5-year interest only term, which will then switch to principal and interest after the 5-year period is up. The next component is that you go for variable over fixed, as it allows you flexibility, especially when you're trying to build a portfolio. You don't want to lock yourself in unless you're comfortable with your portfolio's position. But given this is probably your first investment property, you want the flexibility of the variable rate home loan. And then finally, you're going to ask for the 100% offset account. And that means every dollar, and you're allowed multiple accounts of these if you're a barefoot investor person, or you like multiple buckets for lifestyle and school spending and other buckets that you want to put into different bank accounts. You can have multiple 100% offset accounts linked to the loan, which will offset the principal balance in that bank account. So for example, if you had a $400,000 loan and you actually had $400,000 of cash in the bank account, you would be paying the bank a whopping $0 each month, apart from any fees they might charge you in that scenario. So the 100% offset account is a great tool for you in your portfolio. So that's interest only, a variable, and 100% offset. So running through that example, if you bought a house for $300 and it was now worth $400, and your $300,000 house had a 20% deposit when you first bought it, let me just check my calcs here, that would be $240,000 loan when you first bought the house. Now, let's say you still have that $240,000 loan 5 years later, and you go back to the bank and refinance. That would mean the house is now worth $400,000. They'll give you a $320,000 loan. You'll pay out the old loan, your existing loan that you had, and the difference between a $320,000 loan that you now have and your old loan of $240,000 is $80,000 cash. So hopefully I've made this simple. $400,000 house, $320,000 new loan, and you also have $80,000 in cash, which are going to sit into your offset account. Now, what might you do with that $80,000 cash? You might want to keep it as a buffer for a rainy day, or for when things come up and you need to do maintenance on your investment property. You can, and some people do, buy holidays or spend that money on cars, but I would personally advise in keeping that money. If you do spend that money, it will reduce the amount in your offset account, and you're going to be paying more money to the bank. So that's probably not a wise decision. You're best off using that money to invest into other assets. Now, if you want to dabble into the share market, you might want to do that with the $80,000. But what I would personally do, and what Emily and I have done in our portfolio, is take that $80,000, go back to the bank and use that as another deposit. So an $80,000 deposit would allow you to buy a $400,000 or even more depending on your serviceability, $400,000 home, and that could get you a second investment property. I hope you found this video useful, breaking down the ideal loan structure that I would have for my first investment property, and that you found the comparisons useful and that you might be able to use this in your own investing journey. If you found this information useful, leave a like on this video, leave a comment down below if you've got any questions about loans or property or renovations and all those things. I'd love to have a chat with you in the comments down below. Subscribe somewhere down below, we really appreciate it. We're trying to grow the channel to 1,000 subscribers this year, that's kind of our goal. So that'd be awesome, and I'll see you in the next video. Peace.